Top of the hour now, and let's get started. And I'll start this event as I typically do with a very sincere thank you to everyone who has joined us for today's discussion of active and passive investing with a focus on the Asia Pacific region. If you don't know me, I'm Bob Schmidt, Executive Director of the Brandis Center here at UC San Diego's Rady School of Management. I'll be your host and moderator for today's event. I've got two panelists joining me today. Each is a member of the Brandis Center's advisory board, and both are based in the Asia Pacific region. I'll introduce them in a moment. Our conversation today might touch on what I consider pillars of investing, especially from an institutional perspective, things like philosophy, process, and people. So we might get a little theoretical, but I promise we'll share some practical guidance on this topic for both institutional and individual investors. And just to set the table, we're targeting a focused conversation today. Expect this session to run about 50 minutes. Our panelists will share their insights on the topic for about 10 to 15 minutes each to start. And after each concludes, we'll open the floor to questions. We already got a couple from people when they registered, including one about potential tariffs. So we'll make some time to address that one, but feel free to click that little Q&A icon at any point to share your question, and we'll try to hit as many of them as we can. Full disclosure, we are recording today's event. We'll try to share the recording with each person who registered, and we'll try to get that out to you maybe the next couple of weeks. Now I'm really pleased to introduce our panelists for today's discussion. I'll start with David Iverson. He is head of dynamic asset allocation at Accident Compensation Corporation based in Auckland. He's been there nearly 4 years, and previously he was head of asset allocation for the New Zealand Super Fund for 12 years. He also was a director of institutional investment services and quantitative research with Goldman Sachs and head of consulting for Russell Investments. David earned 3 degrees from the University of Auckland, Master of Commerce in Finance with first class honors, a Bachelor of Commerce in Finance, and he also earned a Bachelor of Laws degree as well. So David, thanks very much for joining us. Next, I'll introduce Daniel Rupp. Dan is the founder and chief investment officer at Parkway Capital in Hong Kong. He established the firm last year after spending 17 years as an analyst and research director at Overlook Investments. Dan earned his Master of Business Administration at the Yale School of Management and a bachelor's degree in chemistry and Spanish at the University of North Carolina. He's also a CFA charter holder. So Dan, thanks very much for being here as well. And I got to be really careful with two panelists, one named David and one named Dan, to get the names right. But I want to go to David. So let's turn things over to you, my friend.
Thank you. Just going to share my screen. Okay. Right. I'm going to make 3 points in terms of active passive. Now, I'm going to focus predominantly on the US just to make a few of these points. And Dan, just as contrast, will cover the Asian region. The 3 points are that active passive, the discussion has usually been quite binary. And the active passive is really more of a continuum. And there are many decisions that can be made between pure indexing and what we usually call, active, which is an active manager. The second one is you've got to know your alpha sources, and there's more than just one. And I'll dig into some of those. And lastly, you need to understand how the alpha source behaves. It's largely how I think about active versus passive. And the conversation, the debate is heated because it's usually a binary one. And the last point is, if you do understand how your alpha source behaves, you're more likely to stick to your beliefs and the strategy, although it's been a tough time for US investors, active managers. So the first point being active passive is a continuum. It is on the left-hand side. There are many other decisions that can be made rather than hiring an active manager. On the right-hand side, there's things like enhanced passive. This is low tracking error quantitative type investing. There are risk factors that can be added. There's a plethora of other types of strategies. And it'd be much more useful debate if it wasn't just either or, but a continuum. And that's really how I think about it, and really the decisions that investors face. So the solutions that fit in either one side or the other. Now, how do you go about this? The way I think about this is really informed by others. A decision-making framework that was introduced by Don Ezra, he was at Russell, and Jeff Warren, who used to be at Russell as well. And then I combine that with some work from Bob Merton that's been talking about this stuff more recently. And the first decision is, in terms of passive, is a market capitalization weighted benchmark. And that is a well, properly defined definition of passive. It's gotten murky more recently in terms of what passive means, but that's how I'm going to define it. And that's one got theoretical backing for it, but it's also one that is macro consistent. Everyone can run and invest in the strategy. But there are other ways. There are other decisions. If you move beyond that, I'm really just walking through the way to think about the decisions between active and passive. And the second one is that passive may not be suitable. There may be other reasons why an index strategy doesn't fit. And it may fit, one, because it's at odds with your objectives. Infrastructure is one of them. If, for example, you're seeking inflation protection, buying an off-the-shelf market capitalization weighted listed infrastructure benchmark may not give you what you're after. And so you might modify that as a result. There may be not a readily available replicable index, like microcap universes are an example. And that's a reason to go active without actually thinking or engaging an active manager. The next broad area is you think active management can outperform the benchmark. And there are three alpha sources. The first, this is Bob Merton, by the way, introduces this framework. I didn't make this up. It's his, and I've used this language as well. The first is what he calls transactional alpha. The second is dimensional alpha, and the third is traditional alpha. And that's usually where we go to. We'll start at the top and think about the index and jump straight to the fourth point. There's all these other reasons in between that could inform how you think about the issue. Now, transactional alpha, I'll give you a very simple example. It works maybe better in fixed income, but I'm going to use an example using equities. Let's just say that you are constrained in some way by a regulator, and the regulator is going to charge you 20 basis points for investing in physical equities. You could have, let's say, a hedge fund that says, well, what we'll provide to you is a swap, and we'll only charge you 10 basis points for that. So you're better off by 10 basis points, and the hedge fund makes 10 basis points from that. And so in that sense, it's a market completion activity. The hedge funds acted as a financial intermediary, and they have earned alpha in a traditional versus a benchmark where they've made 10 basis points. And that's alpha properly defined. Now that type of alpha is a positive sum game. Both parties are better off by engaging in that transaction. Another one might be, for example, stock lending. So there are, there are other forms of alpha that are just not simply based on who's the smartest person or group trying to earn a return from another group. That's a zero-sum game, and I'll come to that in a moment. The second is dimensional alpha. The market return, the market capitalization return, is one risk factor. There are others. And, things like the large versus small cap factor, the value growth, profitability, low vol, momentum, whatever. There's many other sort of factors out there. Not all of them are risk premia, but some of them may be. So there are other dimensions, essentially, to the market factor. And that's why Bob Merton calls it dimensional alpha. Now, if it really is a market risk premium, then that is a risk for reward source of return. Again, if it produces that return, you'll still beat the benchmark, but it's not the zero-sum game. So I've already covered two. Transactional alpha, that's a positive sum game. And the second is dimensional alpha, that's more like a risk premium. And then the last one, that's usually where the conversation goes, is traditional alpha. And that's a zero-sum game, before fees, of course. And that's where the traditional domain of the discussion about active versus passive is, where you have to hire a smarter investor than the other investors in order to earn a return from them. Usually when you just talk about passive versus active, then you end up with two sides, and it's often a heated debate that ends up in very little resolution. But there are other reasons for going active other than just that, and I've outlined those. So that was my second point: is know the source of alpha that you're dealing with, because the cost of it is different. The liquidity requirements, the capacity constraints, and the skill sets are all very different. In fact, if you were to follow this decision-making approach, the structure of an organization thinking about these alpha sources should be aligned according to these alpha sources. And I don't think most organizations align themselves that way. It's usually traditional long-only type manager selectors. Now I'm going to jump into really US evidence in this respect. So I'm going to deal a little bit predominantly with the fourth one, and then hand off to Dan to cover Asia. Why is this important? Well, the rise of passive investing, particularly in the US. This chart shows the amount of assets run on active versus passive strategies, and it's about 50% active and 50% passive. It's been an enormous increase in the amount of passive money. That's partly why this is a sort of reasonably important discussion. I'm going to touch on what the passive investment strategy is, though, in a nutshell. And it almost seems, obvious, but market capitalization weighting only has two components: the current share price and the number of shares. And so if you disagree with the market capitalization should be the basis for setting up an index strategy, then you must disagree with price. Number of shares usually isn't it. Now, there's an exception, was during the Japanese equity bubble, and that's where the number of shares outstanding were being double counted. That's largely been rectified by index providers. So it must be price. An active manager is not thinking about current price, they're thinking about future price, using whatever investment strategy and philosophy they're using. But that's all that passive investors care about, is price. That's it. So if it moves up, increases the market capitalization, they'll have a greater proportion of that in their portfolio. Now, active managers have struggled. So this is a cumulative outperformance. It's a chart I got from AQR, and I updated it. It only went up to about 2017. But managers have really struggled. They went through the tech boom. They made a reasonable amount as the tech wreck occurred from 2003. But from 2009 onwards, institutional funds have really struggled. Mutual funds have declined. They've done worse. I haven't updated them. But it's been 15 years of a tough environment. 15 years, and it's partly the reason why there's been a switch from active to passive. Now, why is that the case? I talked about, understanding the sources. In the case of alpha, for active managers, there are really three components that drive it. One is the skill of the manager. The second is the number of positions that you have. It's really leveraging that skill across the portfolio where you have insight. And then the other one is the tracking error of the portfolio. It's driven by two things. The first is the cross-sectional spread of returns and the size of the positions you put on. Now, what has really gone on in those last 15 years? Has skill disappeared, or is something else going on? I'm going to argue that there's been a tough environment for a few reasons. The first is the stock dispersion has been reasonably low, and that's across most markets, not just the US. It's been Europe and the UK, Japan. All stock dispersion has been low. So if all stocks go up by 10%, it doesn't matter what bets you have on. The index will go up by 10, and you won't make any money. You have to have a dispersion amongst those stocks for you to actually make alpha. The other one is the number of bets. And this environment's been a tough one because of the Magnificent Seven, particularly in the US that I'm referring to, is that long-only managers are usually fund their longs from large cap in order to, and that's been essentially a short large cap position, and it's hurt most managers. So it's been a combination of the amount of breadth in the market, which has hurt managers, and the second is the amount of dispersion which is largely hidden, has also been low. So those are the sort of backdrops to why alpha has been hard to produce. And if I look at the top quartile of managers, they also, you can see it very clearly, even the best managers, the top quartile of them, did pretty well pre-GFC. around 2009 is where the average managers really produced about zero above the benchmark. And it used to be about 3% alpha, and that's dropped down to around 1.3%. So there has been a shift in the environment. So even the best managers. So if I move back to my previous chart, the level of skill, these are the best managers are still there, but the environment's been a tough one for them. And so knowing your alpha drivers and what contributes to it isn't necessarily skill has disappeared. It's more the environment's been tough, and that's been the case for the top quartile managers. So not just simply the average one. So abandoning a strategy where you can, if you think you can find these managers, probably not the right thing to do is essentially the point I'm making. So just to recap, the active-passive is really a continuum rather than a binary decision. I've outlined a way in which you can work through the decision from passive investing to active, and there are other reasons for going into active investing. The other one is know the type of alpha that you have, because the skill sets, the cost, liquidity, and capacity constraints differ across each. And lastly, whatever alpha source you do have, you need to understand how it behaves, and you're more likely to stick to your investment beliefs and stick with the strategy than abandoning it. So with that, I'll hand over to you, Dan, and you can touch on really your experience in Asia.
All right, thanks for that. And I'll try to connect some of your thoughts to mine. Let me pull up this one. Okay, yeah, so I think that David's had a lot more experience across different asset classes, but for me, I've spent about 20 years now in Asia, only in the equity asset class. And in my experience, the passive investing in Asia, it's been really difficult. I think that's the source of a lot of frustration with endowments, institutions in the West, and even with Asians, families in Hong Kong. They also haven't done that well in Asian equities. So that's kind of the broad backdrop in my experience. My experience is a bit different. I worked at a fantastic fund for 17 years, and we were able to put up positive returns, and basically since the fund's inception in '91, match the S&P's performance. But we had to do it thanks to some alpha. The framework that we use and that we currently use at Parkway when we think about returns is there's different components to returns. Here we're looking at a 35-year breakdown of the S&P 500, and those components are earnings growth, dividend yield, and a miscellaneous, which is effectively for the S&P, it's just going to be a multiple change. So this is true for an index. Is also true for a single stock. The point is, if you were to have bought the S&P 35 years ago and held it, you had an entry multiple and an exit multiple, but and those multiples would have grown slightly, but in this case 7.2%, the earnings from 35 years ago, that earnings integer for the index, would have compounded at a little over 7% for 35 years. And if you take 7.2 and divide it by the 10.6 total return for that 35-year period, it shows you that almost 70% of your returns come from earnings. So that was also the experience at my former fund at Overlook, that the majority of the returns were coming from earnings. And so I thought it would be useful as we compare the US, Europe, and Asia to just look at the earnings. So let's go on to the next slide here. So here is, because the benchmark only goes back 20 years, here we have basically a 20-year price chart. It's in log terms for the axis. And so for the last 20 years, S&P has done 10.3%, of which 6.6 is earnings. You can see at the top the entry and kind of exit, or the entry and the current multiples, 17.5 to 23.5. And the third component is the dividend yield. So that's S&P. And I'll have a summary chart after this. Then the next one we'll look at briefly is the Euro Stocks 50. Here, the total return is only 6.6, and the earnings growth is a little over 3%. Higher yield from the Euro stocks, and you can see that the entry multiple was about 16 times, and the current one's 14. So a slight negative return on this miscellaneous. There is one caveat that for the Euro 50 and for our Asian index, these are in US dollar terms. So the miscellaneous component actually is a combination of multiple expansion contraction and FX gains and losses. So the last one we'll look at quickly is Asia. This is MSCI Asia. Ticker is MXAP. So this includes India. And here you can see a similar return to that of Europe with a different combination of earnings growth, dividend yield. And here we also have a negative miscellaneous. I think that in the Asian context, you do have more impact from currency. So if we look at those three numbers in a different form, here we can just look at the earnings growth between these three indexes and a couple takeaways, right? So if we look at the first decade, 2005 to 2014, and then we can also look at kind of the more recent decade. I think what stands out to me at least is, first off, the U.S. earnings have been stable. 6% EPS in the first decade, 6.6 in the second. Europe has had slower growth for both decades. And then in Asia, you see the most recent 10 years, a real drop off in the earnings growth. So the stability of the earnings growth for the U.S., and this is the S&P 500, it's interesting. And also, if you look at this, I mean, S&P 500 earnings growth of just 6.5% can lead to a really good outcome, right? Because you've got dividends, a little bit of re-rating, and so with only 6.5% earnings growth, the S&P has done 10% compound for 2 decades. Another piece of this, as we look at the different these three different geographies, is the volatility of earnings growth. So you'll notice that at the bottom two tables where you've got the red and the green. So the U.S. only has had 5 negative earnings years of the last 20, and some of those earnings years, minus 10 basis points, minus 1.6. These are not big drawdowns in terms of the earnings numbers. Whereas in Asia, you see a lot more volatility in the earnings and generally larger negative earnings years. I mean, 2009, for example, is quite interesting because the GFC in America, it was really an American financial crisis. And with that American financial crisis, you had negative 28% earnings growth decline. That was obvious. That was after 2008 also had an earnings decline. But it was really Asia where the earnings declined 80%, right? So it's interesting that Asia, the index of Asia would have had kind of more negative downside in the earnings than the U.S. where the crisis was really centered. Looking at the last decade in Asia, the bottom line there, you can see that we've got 6 negative earnings years. This is not an earnings profile that you want to own, whether it's in a single stock or an index. And so that, I think, is the fundamental problem in Asia. So let's take that, and you can measure, I guess, we've got the standard deviation of the earnings, so you can see that. I think the first decade is skewed by those big negative years in 2009 and 10 in Asia, but the last 10 years, you can see, again, less earnings growth, more volatility in Asia. That's something you want to avoid. So if we take a step back, we can just look at the three markets. The second row here is what we look at Parkway. It's companies that are over 100 million USD market cap, over $1 million of average daily trading volume. And it may be surprising to see how many more companies fit those metrics in Asia, 9,000 versus a little bit less than 3,000 in the US. I think this is a function of a few things. One is that the US is a more mature market. There's been more consolidation, whereas in Asia, frankly, there's probably too many listed companies. There's a lot of family-run companies, and there's a lot of poorly governed companies. So I think that just from this row and then the next one, which is looks at how many of those companies in the second row have less than five, or fewer than five analysts covering them. So over half of the 9,000 companies in Asia have either no or few analysts covering them, and whereas Asia or US and Europe is a much better covered market. Then we did a little bit of work quickly, just looking at the top 100 companies of each geography. We summed up the market cap, so it's what, $38 trillion of market cap in the US across those 100 companies, and just 9 trillion in Europe and Asia. So you can see the concentration of mega caps in the US here. Looking at buybacks, American companies of the top 100, 90 of them are buying back, whereas only half in Asia. And you can see who's paying the dividends. The last is just a median of the top 100 companies. It shows probably what we all already know instinctively, which is US is a slightly more expensive market, but US also tends to have higher quality companies in their top 100, as evidenced, say, by a higher ROE. So that's kind of the market backdrop. When you look at the last thing that I'll go through is just I don't pay the index providers for a full breakdown, but if we just take the top 20 stocks of each market, I think we can get a sense for really what's in the index. So looking at the US here, this is the breakdown. If we were to aggregate the market cap of these 20 stocks, you can see 47% are in IT. That's actually understating the influence of tech stocks, because if you look at the list here, we've got number 3, Alphabet is considered consumer services, and you've got Amazon as consumer discretionary. So really, the vast majority at the very top of the US is technology. Technology metrics generally, you can see, I think average could be skewed, but the median numbers here, ROAs, ROEs, 12% and 31. So it's a pretty high quality group of companies at the top of the market cap spectrum in the US. If we go to Europe, same thing here. We've got 20 companies, and you can see that healthcare is the leading sector. ROAs, ROEs, 7 and 20%. And finally, if we go to Asia, financials are dominating the top of the top of the market cap spectrum. And here you can see, because of that, you've got much lower ROAs and ROEs, right? So 5 and 3%. So if I go to just some takeaways, like what I think this all means, it's that obviously Asia and Europe, they've lagged the US. The question, I think, is why? Part of the answer to that question, I believe, is what kinds of companies are in this index. And so for Asia, the problem is it is dominated by financials. I think that those financials, on the second point, they've led to more earnings volatility, especially downside volatility. And so this got me thinking, in David's presentation, he talks about kind of enhanced passives. I mean, one, if you're managing, a lot of money, perhaps one enhanced strategy could be just to avoid financials, but be in Asia. I think that would get you probably higher quality metrics in terms of ROAs, ROEs. The third point here is just from my experience, is that earnings growth is a primary driver of equity returns. Going back to my prior fund, Overlook, they had 20 plus years of the way we measured earnings, which it's an inexact science, but we had an approximation. We had our methodology. We didn't have a single negative earnings year. So we had 20 plus consecutive years of positive earnings growth for the portfolio. I think that in a lot of ways explained the outperformance that we got over Asia. And so that's what we're trying to replicate at Parkway. So I think earnings growth, if you recognize that as the primary driver, the focus becomes, how do we get earnings that are stable? And even if you have a negative earnings year, it's a low single digit or a 10% negative year, not a minus 50% earnings year. That's both for the stock at a stock level and at a portfolio level. The fourth point, U.S. index earnings, fantastic, right? And this goes to the strength of the U.S. market and the strength of the S&P. And just finally, you can see the leadership. I'll leave you with two more quick thoughts before we go to some Q&A. China in 1992, Deng Xiaoping was in the South, and you can see some of these numbers: GDP per capita $420, and you fast forward to today, and that's $13,000, right? So tons of economic growth in our lifetimes here. And so if you had the foresight, you saw that growth coming, and you put $100 into MXCN, which is MSCI China, what would that be worth today? And it's a shocking number, but it's only $143, right? So there's clearly a problem here. There's clearly a disconnect. And it still surprises me that you turn on the Bloomberg or CNBC and people talk about, oh, MSCI China was up 1.3% overnight or something like that. It's not an index we should be talking about because it's really a failed index. And yet I think that people still refer to it. So this really gets to the problems in Asian passives. It's slightly unfair because there was a devaluation of the Chinese currency in the late 90s. So the index level, the index launched at 100, and it went down to about, I think, low 20s in the late 90s, and now it's recovered, and that index is currently at 67. The 143 includes the dividend, so it's a price return, or sorry, it's a net return, so it includes both the price and the dividend. So anyway, that's where I'll leave it, and maybe I'll turn it back over to you, Bob, and stop sharing. If people have questions about anything I've talked about, we can go back to the slides, but I'll turn it back over to you, Bob.
Yeah, Dan, that's terrific. Thank you, David. Thank you. And yes, if you do have questions, please use that Q&A feature and just type them in for us, and we'll get to as many of them as we can. I want to start with Dan, because I was scrambling to take some notes here, but if I heard you, tons of earnings opportunities in Asia, tons of volatility, a lot more opportunities there. Can you touch again on what you're paying for the earnings in Asia relative to the US and Europe?
So yeah, in terms of the multiples, it's been pretty widely publicized that or S&P is on kind of low to mid 20s on a current PE basis. The index that we reference at Parkway, because we're not including India, is on 13 times forward. If you include India, so if you look at the MXAP, MSCI Asia, India's gonna pull up the weighting. It's been publicized in the last couple of months, but for the first time, I think ever, India now has a bigger weighting in that index than China. Some of that I think is political, and the powers that be have decided to kind of change the weightings and to increase the weighting for India. So that's going to pull up the multiples. But I think that the skeptics and those who perhaps aren't looking for active management, those who are only looking at passives, they could rightly say that I'd rather pay 24 times for the S&P than pay 15 or 16 times for Asia, given the history and given the volatility of the return stream in Asia. So I think the headline multiples don't alone paint a strong enough picture for people to really want to jump into Asia. If you go into single countries, the cheapest market that I look at is Korea. I think Korea's on about 8 times earnings, and then the next cheapest market that I look at is Hong Kong, and that's on 10 times earnings. So there are certainly some cheap markets, but it's even for China, right? If you want to get China exposure, there are A shares and there are H shares, and currently the A share premium across a broad spectrum of stocks is 45%, or they put it usually at 145. So that means that if you wanted to get China exposure, I think that you could, if you get that through the Hong Kong market versus the China market, you will get discounts. So there's lots going on in Asia. It's not a simple story, and I think that people, people would have done better historically if they either know what to avoid, which sectors or which stocks to avoid, and really keep a concentrated portfolio. That's been my
Okay.
experience. And for the other funds that have done well that are in our orbit, I think have a similar concentrated portfolio.
Okay. Yeah. Thank you. Again, stock pickers environment, so lots of upside potential and pitfalls as well. I want to go back to David and hit on something you talked about, which I don't think is appreciated, which is really at the organizational level, how you determine, do you have the wherewithal, do you have the skill, do you have the breadth within your organization to wring out alpha in the portfolio? And we could probably spend an hour on this. Can you just give us a high level of how you come to that conclusion? Because again, I'm thinking, if I did that kind of assessment with my team, and I'm really honest, and I say, we don't have either the experience or the talent to do that, we should probably go passive. So how do you have that conversation with your team to come to that conclusion?
It's more than the team, it's the organization as well.
Hmm.
And by which I mean there's two areas you need to focus on first before you deal with the competence of the team. And the first are investment beliefs. You need to know what they are. I mean, we've just published or at least put our investment beliefs online. And that's largely how, really at the core of that is, how do you think financial markets work? And given that, what kind of investment philosophy works well with the way you think about the world, which is really the types of managers that fit within your investment belief set. That's the first, investment beliefs. The second one is what competitive advantage you have, because it will say something about the time horizon over which you're expecting active strategies to work. So you need to know what your horizon is, what your competitive advantage is. In our case, we have both of those. We haven't released and probably won't release what our competitive advantages are. That's an internal document. One of the main ones is we have a time horizon that exceeds most others, which means having a long horizon structurally means we can do everything short horizon investors can do and more. I mean, that's a huge advantage. The time horizon of most investors is shortened far too much. They don't have the wherewithal to stick around. So that first is the investment belief set. The second is what you think your advantage is. And then lastly, who do you have to be able to pick these managers? And one of the things, this is really just talking about my days at Russell, was a manager researcher would never be hired unless they had already managed money themselves. And I never appreciated that. And I think that's one of the things that we do. We don't have someone who works through what are the characteristics of a good manager, but more you have run money yourself, so you know what to look for. And you can then dig more into the positioning that the manager has and the underlying philosophy that they say they have, and whether or not they're sticking to that. And that gives you a much greater appreciation than simply performance alone. So those, I think, are the three things: having the right people to do the job, having their belief set well articulated, and having a set of competitive advantages that gives you an advantage in the market.
Yeah, and your comment about time horizon being longer than your peers is obviously super important. And we can talk about valuations a little more. I've heard value investing described as time arbitrage. We'll take the hits in the short term or for the long term gain, but you've got to have that organizational discipline and the buy-in across the shop to make that happen, obviously.
Agree. Yeah.
And
that's not easy, by the way. That's not an easy thing to do. You try to get someone to stick with you, it's very, very hard. So you have to embed that structurally into the organization.
Yeah, and I'm assuming it's just talking about that consistently. Well, here's what we do. Here's the advantage that we have. We may not have seen it, but we have faith that it will bear fruit in the long haul. Yeah. So, hey, Dan, maybe start with you, but for either of you, can you talk a little bit about index construction? And what I mean by that, I was drawn to David's simple, deceptively simple slide about market capitalization is price times number of shares. And the assumption there for a lot of these cap weighted indexes is that the price is either accurate or reasonably accurate. So do you guys believe that? And again, maybe start with Dan. You know, I'm guessing it's a no, but why
Mm.
not?
Yeah. There's a company I like to talk about when I look at index construction, and it's a shipping company called Oriental Overseas Shipping Lines. It's 316 Hong Kong is the ticker, and it's a slide I have in my presentation. But it's it's a shipping company, and it was owned by Tung Chi Hua, then it was sold into Costco. But shipping companies obviously have volatile earning streams. Um, and for a decade pre-COVID, it was about a $2 billion company. And then COVID hits, and obviously shipping rates go sky high. And so the stock goes up 10x. So the stock goes to $20 billion market cap. And at this point, the way the indexes are constructed, and I'm thinking here both the Hang Seng Index in Hong Kong as well as the MSCI China Index, I think it was included because it became a 20 billion US dollar market cap company in the Hong Kong market. It was then included in May of 2022. Typically, for MSCI, I think it's a May and November index inclusion and exclusion. So yeah, they put this into Hang Seng and MSCI China in May of 2022 after earnings had peaked clearly, and then the next year earnings dropped 83%. That was 2023. So if you own the Hang Seng Index in your MPF or in your retirement account or just as a passive investor, you basically bought, thanks to the index inclusion that year, you bought peak earnings and you bought a stock that looked like the NVIDIA share price chart. It had gone vertical. And obviously, I think for most people who have some common sense, they would think it's probably not the best time to buy a shipping company after a 10x move. But the index doesn't even think they do that, right? And so that leads to earnings problems in 2023. That led again to earnings declines, I think, in 2024. So yeah, the buying a stock at the wrong time, it can be quite painful in terms of both earnings and in terms of the performance. But that's an example I think it's in our recent memory, and I think that most high school students probably would know better than doing that. But yet the index.
Yeah, it's amazing to me. I don't have the stats on this, but my sense is that cap weighted indexes continue to get the lion's share of fund flows. And it's, you know, one thing that's often said about them is, yeah, they're backward looking. They're not very forward looking. And to David's point, it's more of a continuum. It's not the binary choice that it may have been, you know, 15, 20 years ago. So there's a lot of room to play in there, but I think understanding how the index is constructed, how it's rebalanced is vital. David, any other thoughts on that one?
Yeah, probably, you know, in terms of index construction, the market capitalization weighted one is rooted in theory. And like I said, it's the macro consistent one. What it underpins it, and you touched on this, is that passive investors are free riders. They're assuming someone else is doing the work for them to bring the price in line. What if it's not? Then it doesn't become a riskless strategy. It's very risky. Well, you know, there will be times when the market is completely misvalued and passive investors, but they don't care. They don't care about current price. That's the only thing driving market cap. I'd make a touch on current, particularly in the US and there are other markets, index concentration has worsened. But that doesn't mean the market's overvalued. It just means it's concentrated. Like I said, it's price times number of shares. If you think the stock value is too high, you think the price is too high. But concentration in and of itself does not mean overvaluation. That's a fallacy. Now,
Yeah.
I do think the market in the US is reasonably overvalued because of that. The top stocks do look that way. But concentration in and of itself doesn't mean it's overvalued.
Yeah, yeah, and for my students over the last 10 years, I've told them because they'll take classes in valuation, risk measurement, and management, and at least in the U.S., I've said the biggest risk in the U.S. market the last 10, 15 years has been being out of the market. And
Mm.
I just worry, I don't think that can continue. But to be fair, I've said that for the last 10 years or so. So at some point it's gonna come back to bite us. But I don't know when that is. But hey, on that front, Dan, if I understand you correctly, do you have any exposure in China then?
Yeah, we do. In fact, geographically, we've got three geographies: North Asia, Hong Kong, China, and Southeast Asia.
Okay.
Hong Kong, China is our biggest current geographic exposure, but we only have one stock that trades in China, and the rest of them trade in Hong Kong. So we're choosing to get because we're a value fund. We have some stocks in Hong Kong that have high yields, and basically the theory there is that the if you look at just the China multiples, right, or if you look at the EM multiples, which is heavily weighted towards China, um, over the last 20 years or so, the index PEs of they've bottomed around 10 times and they've hit that number 7 or 8 times. So it's kind of a multi-bottom. So I think that we've hit, like, I'm not worried about China getting derated in terms of, or Hong Kong getting derated. I think we're kind of at a floor on multiples. In fact, a lot of companies are on generational low multiples, multiples not seen since the late 90s. And so if we get the earnings growth, and I'm not talking about index earnings growth, I'm talking about our single stocks that we're invested in. If those stocks can grow earnings, and Hong Kong generally has pretty high payout ratios, that's what we're playing for. We're playing for earnings growth, which is kind of the key metric that we focus on for the portfolio, but earnings growth with high payout ratios, low multiples, high yields. So that's why we have a lot of Hong Kong stocks because of the yield attraction. Um, but we don't have any A shares. I wouldn't want to go to China and pay premiums, pay high multiples for Chinese stocks if I can get them cheaply in Hong Kong.
Yeah, yeah. And as you were walking through your slides, again, it comes through pretty loud and clear. Earnings growth is the biggest source as you decompose the return. Do you worry about debt levels at all with these companies?
Yeah, I'm not actually I'm not aware of the debt levels for the index off the top of my head, other than I'm pretty sure that the S&P has higher debt than the Asian indexes have. I think generally the Asian corporates, whether they're professionally run or family run, they tend to keep excess cash on the balance sheet because they have a long memory, which goes back to, the Asian crisis, where countries and banks they don't bail you out like they do in the U.S. So I think the U.S. companies, there's a bit of moral hazard there, and they run the business with more leverage. They borrow money to do buybacks, and they do some things to kind of engineer earnings growth and probably higher share prices. And if anything, the problem in Asia is they're too lazy on the balance sheets, right? And so um, excess cash can be a red flag in some ways. It just shows that management has been a bit they're not managing the business to return capital to shareholders, and they're letting the cash build up. So sometimes you got to be careful if you see too much cash on the balance sheet, that it could be a sign of not great corporate
Yeah.
governance.
Yeah. If we have time, I'd love to go back and hit on a little bit of governance. I remember years and years ago, this has to be like 20 years ago, we did a piece on, I think it was cash on the balance sheet of Japanese pharmaceuticals and kind of pushing, do something with that, unlock some value with that. But before we dive into anything on the governance side, we did get a question, as I mentioned earlier, about tariffs. So talking about China, Trump coming back to power here in the US, if there are tariffs on specifically Chinese companies or any companies in Asia, what do you think the impact from that will be?
Yeah, it's kind of an unknowable because Trump has said some contradictory things. But one observation I was when I've had this question a few times because I'm in New York right now, and I was in Boston last week, and I've met some investors, and most of them are asking the same question. One thing is this is Trump 2.0, and I think that a lot of Asian companies, they've been through Trump 1.0, and so they would have now already thought about this, and they would have a lot of companies that we're close to have already moved some manufacturing out of China, or they've got two sources whether it's Vietnam or Indonesia or elsewhere in Asia or even Mexico. So there has been some move already. Now, I think that this could be a steeper set of tariffs potentially, and this could target some of that Mexican offshore engineering or offshore manufacturing. So it remains to be seen exactly what's going to happen. But I also look at I think one of the strongest messages that Trump had to get reelected was to go after Biden and Harris on the inflation in the U.S. over the last 4 years. And so it seems kind of like a head scratcher that these policies that Trump is thinking about and talking about are hugely inflationary. And even though he's going to be a lame duck president, I think he does care about his popularity. And I think the tariffs are, could lead to, even further problems for the middle class, for middle America, for the red states and all this. So I think it's going to be really hard for him to do what he says he's going to do. And so therefore, I think that some sort of deal is likely. And then the last thing I'll just say is that it seems that they're now preparing some different responses to whatever comes down the pipe from the U.S. And so this may actually lead to an outcome where China really has to stimulate domestic consumption. And that's what everyone's wanted for the last few years. So if the exporting business becomes tougher and China needs economic recovery, they need a healthy private sector, then the odds of China really maybe following the U.S. lead in terms of cash handouts or more aggressive stimulus to the individual consumer, that becomes more likely. So that could end up being a positive for the equity markets.
Yeah, the whole tariff thing to me, I agree with you. It's not going to be good for prices and inflation. To me, regardless of who got elected, inflation, I think is going to be an issue. But David, any thoughts on tariffs, inflation, kind of the related topic of interest rates? Do you want to touch on any of that? Grab your crystal ball. No pressure here. Say thanks, but no thanks, Bob. Back to you.
No, thanks, Bob. It's a huge area. I mean, Dan's made all the points. I don't want to repeat them. So nothing more to add.
Okay. Hey, we got a little bit before top of the hour here. Any questions? I'm checking Q&A. I do not see any in there. But David, let me go over to you. I've got a couple more for you, and we can go past top of the hour. But is there anything that you want to hit on that I haven't asked about to this point?
No.
Okay, that was easy.
I could, David. There's one more slide that I had in the back of my slideshow, so I'll just bring this one up. I think it's kind of interesting. Let's see. So this is just I'm tracking here ROAs. I like ROAs because they're unlevered, and so a high ROE because of a ton of leverage is not necessarily the ROE that you want. So ROA is unlevered, and here we just go back, to S&P goes back to 91, and you can see that the change because I think of how the Mag 7 have performed in the last 5 or 6 years. You can see how the ROAs for the index in the U.S. have really taken off, and you can see that's in blue, and then in purple there, that's the Nikkei starting to move as well. And then on the other side of things, MSCI China, and then the FTSE Asia Pac, which is my benchmark. ROA's close to 1%. I mean, to get a 1% ROA is atrocious, right? You can put your money in a bank and get better than a 1% ROA. The only way you get ROAs this bad, it's a few possibilities. One, life insurance banks, they tend to have low ROAs. And two, companies that are losing money, like that shipping company, perhaps, or other cyclicals. That's really the only way to get ROAs this bad. And so this is why I think outperforming in Asia is so much easier, because where we are now in this low end of the return cycle, getting back to David's idea of trying to have some sort of enhanced product, if you can avoid loss-making companies in Asia, right, or currently losing or who could lose money, or companies that have really big balance sheets and low profitability, that's probably a recipe for outperformance.
Yeah. Yeah. And I was scrambling to take notes, but again, I think fewer than 5 analysts 40 and more than 100 million in market cap, 4,700 stocks in Asia versus 664 in the US and like 120 in Europe. So yeah, big
And
opportunity set.
the other thing about that chart is, I mean, China didn't used to be such a low return market, right? I mean, China had periods of outperformance. It's been a while, but in the early 2000s, that also corresponds to the period of a weak U.S. dollar. But yeah, MSCI China had periods where it was probably a higher quality index, but where it is today is probably not something that you want to own.
Yeah, and you just remind
Mm,
me. I'm going to bring up something, and I hope I can remember this. I think it was Dimson, Marsh, Stanton years ago did a study
mm,
on the relationship between GDP and stock market returns. So,
yeah.
Dan, if I remember that one chart, you got things going really well on the economic side in China, but you're not seeing that translate to equities, at least over the index. And people tend to think the relationship between those two things should be hitched, but it often isn't. So again, I think there's an importance for not just making a bet on a country or a region, but doing your homework and looking at some of the companies within that region, within that index to see, okay, where is the fundamentals kind of decoupling from returns, or is this really being captured? Yeah, the economy is doing great, but the market may not be.
Yeah, that GDP returns relationship is a fallacy, and they do a great job of pointing that out. Years ago, there was a push into emerging market mandates, and one of the rationale given was higher growth in emerging markets, and that, as Dan has already pointed out, did not translate to higher returns. In fact, the best way to actually minimize your exposure and get access to emerging markets was, ironically, through US corporates, the ones that are already set up in emerging markets. So,
Yeah.
and by the way, Dan, the way you beat high ROA companies in the US is invest in the Mag 7. That's it. It's quite simple. You overweight NVIDIA and you would have crushed it. I'll say tongue in cheek because no one in the right mind, well, who was thinking from an active perspective. So that passive guy sort of won on that one.
Yeah, but as we've discussed, how long will that continue?
Yeah,
Well,
my prediction. Go ahead, David.
yeah, I agree. I mean, I'm going to put a chart up just to show the magnitude of this this price rise. So I'll share my screen again. Go away. Here we go. So that's the Magnificent Seven, and I went back to around about the COVID period 5 years ago, and you can see this rally. The white line is the Magnificent Seven. They're up 6.4 times, and here's everything excluding the Magnificent Seven, only up 1.7 times. It's astronomical.
Yeah.
And you've looked at some of the metrics, and you look at the P ratios where Apple was trading on something like about 14 P, and now it's north of 30. And so this is the US concentration. As a result, this is the more worrying one. You're getting levels of concentration in the index, which is what you'd seen around this sort of late 60s. So there was sort of nifty 50 period. And so, this is sort of the more worrying part, how concentrated it is. And this is all relative, of course. Different markets have different levels of concentration. This is the US with respect to the US. Like the top stock, and this is a little bit outdated, but it's sort of 6% of the index. And the US market is about more than 70% of the MSCI, world index.
Yeah.
So how long can this be sustained? This is post-COVID money printing, right? That's what resulted in the lowered risk premium. You then had Powell increase interest rates, and so this is an interest rate effect. But since then, we've had an AI boom, the Trump rally. It just keeps going. Let me stop sharing now. Oh.
They got one question from a participant. Should we think about the returns from US versus Asia as an indicator of fundamentals related to governance/demographics or a result of market cycles that have recently favored US big tech? So returns is an indicator of fundamentals related to governance, demographics, or market cycles that have recently favored U.S. big tech.
I'll take a stab at it, and David, you can feel free to
Mm.
add. I think that there is an element of fundamentals to it because the earnings growth has accelerated recently, but the returns far outpace the earnings growth. So there's also an element of re-rating. And I think where we stand today, there is some extrapolation of perhaps recent trends in terms of continued U.S. growth. I think the U.S., those top 20 companies, they've gone global, they've taken global market share, they're dominant, some of them are monopolies, and so that's in the current earnings that you see. And now I think the problem is going to be, where do they go from here? I mean, where does Facebook go? They've already got a big share of the advertiser's wallet globally. Can they keep growing? So I think that's where there's risk. But there is an element of fundamental, really good performance in the U.S. There's also an element of expectations from AI and whatnot that's going to drive the next leg of earnings. If that doesn't come through, then there's potentially trouble in the U.S. But I think as long as the U.S. outperforms Asia, it will be very hard to raise money for Asia because, people ask themselves, why bother, right? U.S. keeps outperforming. So I think it's going to take probably a crack in the U.S. markets to really bring back some interest into other markets. And until that happens, if and when, the correction happens, it will be hard to get interest, I think, to come back to Asia despite lower valuations.
Yeah, I think you've touched on it, the underappreciated aspect is the quality of the companies is clearly different. They're very high quality companies in the US. The question is, what are you paying for that? And the risk premium, the untalked about, has shrunk. So you talked about re-rating, Dan, but if you actually measure the risk premium, it is razor thin. The expected returns on the S&P compared to the bond yields is partly why Warren Buffett has now sold down his Apple holding. It is simply the value in that company just doesn't stack up. So the risk premium is razor thin, and that's one of the contributing factors. And we'll explain some of the P dispersion, but it's wider than ever.
Yeah, and we touched on this a little earlier. I think David, you had mentioned Cliff Asness and maybe not specifically the piece that he wrote kind of end of the summer, end of August, where he talked about the longer term outlook would be more volatile markets and value likely winning out, but you're going to have to wait a longer time to see those benefits. And we talked a little bit about this before. I think he's talking his book to a certain degree, but I also think he's right. It's just having to wait to get those benefits might be tougher than it's been in the past. And investors are sitting out there already saying, well gosh, how much longer do I have to wait?
What he's pointed out is when you're playing the traditional zero-sum game, the smart money has to make money from the dumb money, essentially. Someone's giving you alpha, and it's the other side. What his observation is that who's leaving the table? Is the dumb money or the smart money leaving the table? It's probably the smart money. Now, if that's the case, that leaves more of the dumb money, and I'm not saying they're necessarily dumb, but it's the money from which you're getting your alpha. Now, the other side, there's more of them in the market. That makes the market more inefficient. Gives you an opportunity, if you're an active investor, to eventually harvest a return. But it comes with a risk, and the risk is you have to be able to hold on to the losses. So you get a higher return, but you get a higher risk. He says it's a fair thing. So if you're an active manager, you're in a far better position, to generate a return. It's going to come with some risk, and you're going to have to sit on pain. Most managers in the last 5 years, I showed you the charts, particularly in the last 3, have hurt a lot. Yeah. And to try to stick with your strategy during this, it's very, very hard to do. And it's ultimately the capitulation of the institutional investor gives up on their strategy, and that's when the market turns. This was a classic in the tech boom around 99. Value managers turned to growth managers. And and the thing turned. Folks who thought that they stopped betting against the market. GMO's one of the managers that lost around 2/3 of their business through that period. Eventually were right, but it's pretty hard to stick to it. And that was his point. It's probably an easier game now because some of the smart money says, I can't do this, so let's go passive. Now they've left the market. That leaves a lot more other investors around that are probably less capable at pricing these stocks. So that gives you an opportunity. But it may look inefficient, the price may look wrong, but it's pretty hard to stick with it. But if you can, there is gold at the other end.
Yeah. And hey, along that line, do you make any tactical bets in your allocations to active and passive managers?
No, we don't. That alpha timing is a pretty hard thing. Just trying to get alpha full stop is hard enough. You're constantly watching the managers and ensuring they still have the skill which you've hired them for. But to tactically time, no. And if you're going to do that, you're most likely to do it at the wrong time. So we don't do that. I mean, Cliff Asness's view was, and he applies this to styles, don't tilt the styles, right? And you make one cardinal sin. He's done that, I understand, recently, but I mean, I can't confirm that. It's very, very hard to do. So we don't do that with styles. We don't do that with our active managers.
Right. Thank you. Hey, Dan, I know we're a little over here. Do you want to talk at all about governance issues and if or how that plays a role in security selection for you?
Yeah, it's in terms of an ESG framework. I mean, the G is probably the most important, especially as you go down the market cap spectrum. And within the governance, it's really the capital allocation. So yeah, there's a lot of pitfalls in Asia, especially with companies that really don't want to have high share prices. I mean, currently what Korea is struggling with, and one reason why it's been such a bad market for so long is there is there's an inheritance tax at your marginal tax rate, which I think is above 40%. So we look for chairmen or the leading shareholders who are, less than 60 years old, because once you're above 70 or 80 years old, some of those chair people, they're intentionally keeping the share prices down so as to minimize a tax bill for the next generation. So it's pretty perverse. But there's things like that you have to be aware of, and so there's lots of issues. But yeah, you need to get to, I guess, what drives the management and the owners, and whether or not a high share price is in their best interest. And so there's lots of nuance in the Asian markets, but there's plenty. We like to look at what companies are doing, not what they're saying. The buyback disclosure in Asia is pretty good. You generally get daily buyback disclosures, like US or the Hong Kong market every day at 6 p.m. You can see who bought back and how much and what price. Same thing in the Philippines. Same thing in China. Ditto Korea. So whereas in the U.S. you have to wait till a quarter end, and you have to wait till they release their quarterly results to see what happened in the prior quarter. So with the timely buyback disclosures, we can look at, say, and especially we do this after a really bad day. So if Hang Seng's down 2%, which unfortunately happens more than I would like, those are the days when I really want to check the buybacks and say, okay, who was awake and who actually did something today to support the share price in a tough day, in a tough environment. And it's funny. I mean, sometimes you get currently some of the buyback champions, AIA, they're buying back 8, 9, $10 million a day, US dollars. Tencent was buying back a lot. So some of the large caps are doing a good job. HSBC is doing a good job across a lot of different areas. They're cutting staff. So we track what companies are doing, buybacks, dividends, staff levels, who's cutting staff. You mentioned before GDP growth is slowing. That's okay. We have companies with 5% revenue growth and low to mid-teens profit growth because they're cutting staff and they're trying to manage margins. So yeah, governance is really important.
Okay, thank you. I'll ask one more time. We went longer than I thought, but you guys have terrific insights to share. So anything that we didn't hit on, any closing thoughts? We kind of touched it all.
I
I
really
think
enjoyed
so.
yeah, I think I've talked too much. So
Okay. Okay. Well, out of that and interest in everybody's time, including yours, we'll wrap up there. And I'll just say thank you very much, David Iverson. Thank you very much, Dan Rupp. I also want to give a shout out to the team here at Rady that helped make this possible: Priscilla Morales Salazar, Elise Grail, Chris Blanchard. And I am going to put my email address there in the chat. If you'd like to join the Brandis Center email list, I promise we won't inundate you with stuff, but we'll keep you posted on new releases of research and future events such as this. So if you're interested, please reach out to me. Gentlemen, thanks very much again. Thanks everybody for joining us. And this will conclude our event for today.